So something really strange is happening in the Australian property market right now. It feels different. The Reserve Bank has been trying to do everything that it can to cool things down, keep inflation lower, and restore balance. But here's the crazy part. The market, it's just stopped listening. Despite interest rates still sitting at 3.6%, house price expectations, according to Westpac, have just hit a 15-year high. And that means that Aussies haven't been this bullish since 2010. And history tells us that when sentiment hits these levels, prices don't just rise, they run. So what's actually going on here? Why is confidence soaring whilst affordability is at record lows? And the RBA is insisting that it's doing everything that it can. And trust me, you're going to want to stay around right until the very end, because in this video, I'm going to touch on why the RBA is completely losing control of expectations, and it could just mean that a new property boom is already occurring underneath the surface. Guys, my name's Josh. I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you smash that like button. And with that said, let's jump straight into what the RBA losing control actually means. So the RBA's main weapon, it isn't the cash rate. It's actually expectations. And if people believe that interest rates are going to remain high, it tends to delay the investment decision-making process. On the other hand, if people believe that interest rate cuts are coming, they act early. And that's exactly what we're seeing happening in the data already. If we look at the most recent Westpac house price expectations index, it's just hit 172, well above the long run average of 129, and even higher than the boom that we saw during COVID times. Back then, prices rose over 16%. And when optimism gets this strong, it usually means that there's something much bigger hiding beneath the surface, the kind of shift that no one's really in control of anymore. But it's what happens after that point that really matters. So with that said, what's actually driving this boom psychology? Firstly, it's rate cut expectations. Now, we've already seen 3 rate cuts this year. The cash rate's currently sitting at 3.6%, and the RBA is still saying that this is in restrictive territory. But at the same time, the market is expecting more rate cuts in the near future. Depending on who you're listening to, there's at least 1 to 2 more interest rate cuts expected. And housing researcher Nick Garvin summed it up perfectly when he said, if you've got a situation where rates are moderately high, but people expect them to decline, that expectation alone can lift house prices. So in other words, people aren't waiting for that formal rate cut from the RBA. They're already acting on the expectation that those rate cuts will come. And what that means is that there's going to be price pressure in the upwards direction right now. Secondly, you've got the newly revised 5% government first home buyer deposit scheme supercharging demand. All that this scheme is going to do is pull forward a wave of buyers who otherwise wouldn't be in the market. And as the former Treasury official Gene Tunney said, the scheme has created a large pull forward of demand. And here's where it gets dangerous, because when government policy, rate cuts, and FOMO collide, it stops being about fundamentals and starts being about momentum. And that brings me into my third and final point, which is chronic undersupply. So building approvals fell by 6% in the most recent August ABS data after an 8% drop in July. And we know that the national housing target seeks to build 1 million homes over the next decade. And that target, it's already way off track. So when you combine pent-up demand with record low vacancy rates, it's not hard to see why buyers are panicking to get back into the market. Now, here's the part that no one's talking about. The RBA knows all of this, and they're still choosing to stay out of it. So what is the Reserve Bank actually saying? Well, Governor Michelle Bullock has been crystal clear. She said, and I quote, "The bottom line is that all I can do is keep inflation low and stable and keep employment strong. because that gives people the best chance to get into housing. But when it comes to property prices, there's nothing I can do. In other words, the RBA has completely checked out of the housing conversation. Its focus is inflation and jobs, not property prices. And while that might make sense in theory, in practice, it's left the housing market to run wild, fueled by sentiment, policy, and scarcity. And that's why the median price has jumped by $127,000 nationally since 2022, despite affordability being at decade-level lows. We've got record demand, chronic undersupply, and a central bank that's saying that this is not my problem. It's the perfect storm for another runaway cycle. And by the way, if you want to understand how the 5% deposit scheme is actually impacting prices, I've made a full video breaking it down. I go through how the scheme works, what it means for investors, and why it's quietly shifting the market more than people even realize. You can check it out right after this one. I'll link it on the screen above and in the description box down below. So with that all said, has the RBA made this type of mistake before? And this is where it gets interesting, because history shows us that this isn't the first time that the RBA has underestimated housing momentum. Back in 2015 to 2017, they were worried about wage growth and inflation being too low, so they kept rates lower for longer. What happened? Well, Sydney and Melbourne surged more than 40% in that time period, and household debt, it hit record highs. By the time that the RBA reacted, it was already too late. It only corrected when APRA intervened and introduced restrictions on lending. Then again, when the pandemic hit, and we all know this, famously the RBA said that the cash rate won't rise until 2024, the big promise. And the market heard that and it went absolutely berserk. National prices jumped 25% in just 18 months. And suddenly, the RBA was scrambling to hike the cash rate by 400 basis points in just 1 year. So each time, the pattern, it's the same. The RBA loses control of expectations, the market then front runs policy, and affordability, it collapses. And right now, the exact same ingredients are back. Rate cuts are expected, demand policy is in play, and a central bank that's once again saying, housing is not our problem. And if history repeats even halfway, we're in for something massive, because this time, whilst the fuel tank might be smaller, the spark, it's significantly hotter. So with that said, what happens next if the RBA stays hands off? Well, the longer that they wait, the more that sentiment snowballs. And Westpac's senior economist has actually warned that the longer that the RBA delays, the more likely it will end up cutting by more than it currently envisages. So in other words, if they delay now, then things will overheat later. And if that happens, then affordability isn't going to improve. It'll only deteriorate further, because whilst wages inch up 3% each year, property sentiment is surging 30% above average. If you're finding this video helpful, make sure you hit the like button and subscribe. It helps more Australians cut through the noise and actually understand what's driving Australia's property cycles. So with that said, what does all of this mean for you? Well, here's the takeaway. The RBA, it's losing grip on market psychology, and the government's 5% deposit scheme, it's front-loading demand. And this is all happening while supply is completely collapsing, just as migration remains at its strongest levels in recorded history. And when you combine all three of those factors, you get pressure, momentum, and a central bank that's not even trying to stop it. And that's why I genuinely believe that we're heading for another acceleration phase in 2026. But I'm curious to hear what you think. Should the Reserve Bank take into consideration property prices when they're setting interest rates? Or are they right to remain purely focused on inflation? Drop your thoughts in the comment section down below. I'll do my best to respond to each and every one of you. So with that said, has the RBA lost complete control? Well, maybe not completely, but they're definitely not steering anymore. Right now, the housing market, it's moving purely on belief, not policy. People believe that prices are coming down, they believe that supply will remain tight, and they believe that prices will only keep rising. And when belief takes over data, that's when markets become very unpredictable and powerful. Whether that turns into a short-term frenzy or a sustained property market boom, that'll come down to one thing: how fast confidence turns into action. Guys, if you found this video helpful, make sure you hit the like button and subscribe. Also, check out my completely free property due diligence checklist in the description box down below. It's the exact framework that I use to assess property transactions. And with that said, hope you got value out of today's video, and I'll see you in the next one.